Hello. Well, it seems like the ECB have clearly delivered. They've seen market expectations, they've taken it one step above, and there's certainly a lot of finite details that we've seen that we probably were looking for it to be expected to see in the March meeting. Certainly in terms of the actual size from the ECB, 60 billion a month there. Of asset purchases, public and private. So we're going to see 45 billion in sovereign debt being purchased. We're going to see about 5 billion in agency bonds, and then we're going to see 10 billion in covered bonds and asset-backed securities as well. So that run rate is certainly significantly higher than what the market was looking for. We were told yesterday, or certainly was leaked yesterday and highly speculated, that we would see 50 billion. So 60 billion a month up until September of next year. Gets that balance sheet above 1 trillion. But the most important thing here is they say they intend to do so until they achieve their mandate. So effectively this is open-ended, so they can finish quantitative easing prior to September 2016 if they get inflation expectations up to 2%, or they can continue doing so until they meet their mandate. So they can actually buy bonds past that specific date that they specified. In fact, what we're probably likely to see, and what my base case is at the moment, is the inflation won't move up as significantly as they probably hoped, and we may actually see the size of that program being taken up to about 80 billion a month further down the line. We're likely to see euro-dollar trade nicely below that 110 level and probably onto parity by the end of next year as well. Certainly in the short term, what we're seeing from the price action in euro is that any kind of rallies are being jumped on. You've got to be looking to sell any kind of rallies in the euro, especially against the greenback at the moment, which remains the strongest currency. Euro-yen's been under quite big pressure. In fact, the euro fell quite nicely against all currencies, as you would expect last night, with the exception of the Danish kroner. We did see the Danish central bank coming out and cutting their cash rates by a small amount as well, try and move money away from that and defend the peg as well. So I think that's quite interesting going forward. We also know that there's going to be shared responsibility with the national central banks. We knew that was going to happen, but the ECB are going to take about 20% of the debt burden, and then the national central banks are going to wear about 80%. So if there are haircuts further down the line, most of the risk is going to take at a national level rather than with the collective organisation there as well. We also know they're going to be buying bonds anywhere between 2 and 30 years, probably likely to move it sort of in that sort of 5 to 7 year duration, but they said they are not opposed to buying bonds with negative yields as well. And I think also if you are a bond investor, you are looking at this situation where the ECB will be buying, and they're going to be very much on the same level playing field. They're going to get the same treatment as private creditors as well. So that effectively means if we do see haircuts under the collective action clause, the ECB will be sitting there and treated exactly the same as everyone else. We know this year there's going to be further targeted long-term refinancing operations, or the TLTROs. The level or the price or the level which they're going to be able to get funds from the ECB have been taken down as well. Makes it a little bit more attractive for banks to try and pick up some of that cheap liquidity. Whether or not they actually end up using that further down the line is yet to be seen. So the way this is going to work, we're going to see obviously an expansion of base money. The banks will therefore be the key beneficiaries of that. What they choose to do with those funds, obviously they can lend that into the real economy. Is that going to happen? Probably not. It seems to be the view in the market. There's a bit of a savings glut in Europe, and certainly the demand from credit is not particularly there. Of course, they can then go and invest that money with a central bank's balance sheet and keep it on the balance sheet. But of course, in Europe, they have negative deposit rates, so certainly European banks will not hold the money with the ECB. They can look at the Fed, where you can still get about 10 basis points, or even in Japan, where you can still pick up 20 basis points or so, and you can still pick up about 10 basis points in Japan as well. So that's going to be quite interesting. But ultimately, I think what's really going to happen is you're going to likely see a lot of that money making its way into the equity market to pick up yield. And I think that's really going to be the trade. Effectively, the ECB are funneling money into the equity market. If you look at price action on the DAX, if you look at price action on the CAC, if you look at it on the Euro stocks, we're seeing good breakouts, especially in the DAX. The CAC has broken its longer term downtrend, and those markets look absolutely fine to me. I like being long in those markets. They are a little bit overbought. I think pullbacks remain a good buying opportunity. If you're looking in actuals on a stock level, stocks like ING look quite good. In Tessa, Barclays in the UK, for example, SocGen I think will do quite well out of this. And then you can look into Italy, stocks like Banco Popular will probably do quite nicely over for a short to medium term period here. When the ECB wants something, when a central bank wants something, you generally get markets reacting, and you probably align yourself with their strategy and you do quite well. But if you look at inflation expectations last night, I think it's really interesting that we did see five-year swaps actually tick up about 8 basis points. They're now 1.7%, 1.78%. So inflation expectations as a result of what we saw last night have increased, and I think that's quite interesting. But they still are not suggestive that we are going to see the quantitative easing program that we've seen in its current form actually generating any inflation. This is going to be very good, I personally believe, at an asset level, but probably not great for inflation. I don't think it's going to have a massive boost for inflation longer term, but as traders we can still take part in that. Now I think it's also interesting to see the Aussie dollar. We've seen it break through 80 cents today. There's a real belief that the RBA will have to come to the party. We get the CPI print next week. If we see it below 2%, the RBA, for all intents and purposes, should cut rates and join the global easing situation, and that's why we're seeing the Aussie dollar below 80 cents. The Bank of Canada led the way yesterday and certainly caused a big move there. They were not expected to cut. They were not expected to cut for most of this year, if at all this year, and I think the RBA will have to take a lesson from that. But certainly we're seeing the US markets now about 1.5% from all-time highs. We're staying long in those markets. The Australian market today should see a very strong gain. We're going to see risk-on sectors doing, risk-associated sectors doing very well. The ECB have delivered. They've delivered not just in size, they've delivered it open-ended. The timings are much more aggressive than markets for, and we've got more detail. Probably the only thing that really is probably disappointed a few, not too much, is the fact we haven't seen an announcement on corporate debt, which would have allowed them to achieve that balance sheet much better. Certainly, it's risk-on at the moment, and we're staying long risk and certainly staying short euros at the moment.